Think your rental property is cash flowing? Cool. Show me the math, because chances are you're overestimating your return. Let's break down why and what that means for your plan. At a recent FPA retreat, Rich Arzaga shared something bold. When clients tell him how well their rental's performing, he mentally knocks 5% off their return. But why is that? Because of optimistic assumptions, untracked costs, and no real benchmarking. His quotes: "It's ownership bias versus reality. We fall in love with our properties but forget to factor in the real costs. Maintenance reserves, things like roofs, concrete, HVAC, $30,000 to $40,000 every 10 years. Property management, even if you are do-it-yourself, and you probably shouldn't. Entity filings, tax prep, insurance, legal fees, debt service, vacancy periods. That cash flow you thought was $75,000 could easily be negative $1,000. And if that property is part of your retirement strategy, that math matters." Arzaga gave the example of a couple with $3.6 million net worth and $75,000 a year in rental income. But after expenses, they were losing money on it. If they retired at 65, they'd run out of money by 84. Not what you would expect with that net worth. It's clearly not because they didn't save, but because the asset they relied on wasn't pulling its weight. That's where planning steps in. Not to tell you real estate is bad, but to run the actual numbers and show you what that asset is really doing for your future. Because sometimes selling the rental, paying the tax, and reallocating to a better strategy can leave you with more wealth, less stress, and way more time. Because when your plan accounts for every part of your financial life, not just the portfolio, you're not just diversifying assets. You're learning to navigate your wealth and elevate your life. So like and follow to do just that.